Good morning. Today is Saturday, the 7th of October, and we're in the last quarter. And we had some amazing numbers out of NFP last week. I don't know what to make of them. In fact, I think I won't make anything of them because they are incredible. Anytime you get double really what the market expects in terms of jobs created, and also at the same time a moderation in average hourly earnings, I find that pretty incredible. And I have to think that there are some statistical quirks in those numbers, and that is probably, by the end of the day, what the market concluded, because we ended up pretty much unchanged in bonds. Still, we keep on going up in real yields, and we hit 255 in real yields. And that is something that we have to talk about, Andy.
Yeah, absolutely. The rest of the data for the week was fairly strong. There was no auction supply at all. It was all T-bills. And the trend continues for bonds to be down. They did hit a short-term, maybe, bottom, very aggressive sell-off on the NFP number. Again, it was extremely hot in one sense and less so in another. And I think we're going to get volatile numbers that are hard to estimate. So it's, that's not what we do. But, bonds continue to sell off still on this very large supply. Next week, we have supply as well. We'll talk about that in a moment. But, in terms of markets, the 10-year yields, as Nick was saying, both real and nominal, reached close to, the cycle high by the end of the day on Friday. And equities began, did frankly the wrong thing on the announcement of the data. A strong economy is at some level just good for equities. We're going to end up with a nominal GDP, real GDP that could be 4% for the last quarter. And so a strong economy is generally good for equities. And so the very, very rapid sell-off that we saw on Friday didn't make a lot of sense to me. Fast hands could cover and buy some stocks and catch a little bit of a rally on Friday. But, when we end the day, bonds were down modestly. Stocks were up modestly. And, that's what you should get when you get a strong number.
Yes, absolutely.
What do you think about the Fed in terms of the number?
Well, the big question is this enough to make the Fed tighten? I'm 50-50 on the fence on that one. I think they would like to be done. I think the CPI number that we get next week is going to be more important than this number in determining whether they hike or not. But the market certainly, by its reaction in the very short end on Friday, I think decided that it was unlikely that this number by itself would make them tighten again. So we will see what the CPI brings, but I tend to agree with the market that they would like to be done and they would like not to have to hike again. I think the real question is what happens to nominal yields and real yields going forward in the next few weeks. Because every time we've hit in the past, I don't know, let's call it 2 decades, every time we've hit above 250, between 250 and 270 in real yields, that has been a top. So what does this imply? This implies that unless we can see a divergence between nominal rates and real rates, it's very unlikely that we get big movements in either over the course of the next few weeks.
All right, let's talk about what to look for next week, and then we'll think about the longer term for the month. So next week, we have a significant amount of auctions into what has been a very, very weak bond market, with threes, tens, and 30s being issued on Tuesday, Wednesday, and Thursday. The bond market, the cash bond market, is closed for Monday for, I guess it's now called Indigenous Peoples Day or Columbus Day. And we've got the CPI, firstly the PPI, and then the CPI later in the week. And so it's a perilous period of time for both data and supply. But I tend to agree with Nick. We've had a significant correction in the bond market, and that speaks to whether this correction has made sense. So I think we have to review our macro outlook and really talk about real yields at this stage.
Yes, and the real thing is, are real yields and nominal yields going to diverge? And I can't see that they will in the short term or even in the longer term, because if we are now hitting cycle highs around the anywhere between 250 and 275, that would imply very little movement in nominal yields for the next several months. Now, how realistic that is, I don't know, but the big event is going to be the next QRA, because I think all the very large players have figured out that the QRA is now the most important piece of data that is going to come at us, and we are going to get much more supply. So the question is, have we priced in, where we are now in nominal and real yields, all the supply that is going to come at us in the next quarters? And the QRA, which comes out on the 1st of November, right, which is going to be very likely to show us even more supply in the bond market in the periods ahead. So that is the big question for the market going forward. But I really think that at 255 10-year reals, that has to be attractive, and some money and a lot of players will park money there, which should stabilize nominal yields for the time being until and unless we get much more supply announced in the next QRA.
Yeah. So what Nick's basically saying is our big call on July 31st with you all was for this supply catalyst to have a major impact on the bond market and also transfer some of that impact into the equity market. That was a wicked quality call, and we saw now 10-year notes sell off by 90 basis points. So now the question is, what's next? And the first thing you have to ask yourself is, back then, did the market understand the impact of the QRA? And I think it's clear by the price action, they haven't. So, celebrity major hedge funds like Bridgewater have sent out videos to the public saying that the QRA is now the quarterly refunding announcement is now the most important piece of data. Now, that's something we all here have been focusing on for, Nick probably has been focusing on that report for his entire life. But as it relates to the impact on overall assets, it's been a key part of what we do here in understanding how assets work. So now we're in a position where all of a sudden this piece of data, which determines the amount of bond issuance, so the amount of supply of bonds, in August went from 178 billion for Q3 to 338 billion for Q4. So now people are paying attention. So, I think we're still well ahead of the money, meaning the average sort of marginal dollar of who is appreciating what piece of data, and still think there's quite a bit of edge in terms of predicting that. And so let me run through briefly what a prediction might look like. The amount of new money that the government needed in Q3 was $1 trillion. The amount of new money that the government needed in Q4, which is where we are now, is, I think the number was 851 billion. Might be off by a little bit. Even if you just project a Some of that was what they call TGA rebuild, which is their checking account goes up. But if you project a fairly low budget deficit and the effect of quantitative tightening, you've got about a $600 billion number. We know that the Treasury has issued far more bills than they are historically been comfortable issuing. And so that's around 22% of the outstanding. So for them to slow the amount of bills outstanding, they would have to issue less than 22% bills. Maybe they won't. Maybe they'll just issue 22% and stay fixed at that level. If they were to do that on the 600 billion of bonds of total issuance, you're talking about something like 480 billion of new bonds. Now remember, this Q3, 178 billion. Q4, the announcement of 338 billion caused a 90 basis point sell-off in bonds. And just the basic rough projection, I'll refine it through time, but the basic rough projection would take you to 480, which is again another 150 billion more bonds. So 300 billion more bonds than were issued in Q3 would be issued in Q1. That's a lot of supply, and the market we think, has yet to fully discount not the future supply, because it won't end there. Q2 will be similar. Q3 will be similar. This is 2024. And so that wall of issuance of 300 to 500 billion of bonds is just not going away. And so that has significant implications in the medium term. And so where we are now is trying to judge how much the market understands this and how much is already priced in. Has the 90 basis points of 10-year yields that have taken real yields to 2.5% priced in all of that future bond supply? We don't think so.
Yes. What's going to be interesting is actually trying to determine who the marginal buyer is, who is going to buy all these bonds. It's not going to be the Japanese like it was in the 80s, because it doesn't make any sense for them to buy on a swap basis, because JGBs actually yield them more if they were to swap out back into yen. So we can forget about Japan. Is China going to buy? Well, I don't think that they're going to buy what they've always been buying, and i.e. they're going to invest their trade surplus. But I don't think that that is going up necessarily, so I don't see that they're going to be a major buyer. Is it going to be Europeans? I doubt it, because again, bunds, the spread between bunds and US treasuries has been going out, but it's not yet at such attractive levels that they would swap out of euro-denominated bonds and go into the US. So we are really left with US buyers. And who are the US buyers? Well, it's people like you and I with their 401ks, but I don't think it's going to be hedge funds, and I don't see the attractiveness for them in buying these yields. But the real yields are very, very attractive, historically speaking. Can they spike further? I guess they can. I don't see any reason why they can't get to a little bit higher, but I just can't see them that much higher, because they would really cause a recession, I think, at the end of the day.
Right. And, I think that is the goal of the Fed, to slow the economy rapidly. The question is, into a recession, they'd prefer not. Now, you mentioned nominal bonds and real yields, and I think that's an interesting point. I think real yields, you have to step back and say, are these something that you would want to own at 2.5%? And the answer to that is very much so, yes. The question is, can you get it at 3% or 3.25%? And of course, that is possible. We've just told you of the significant amount of bond supply, and we don't know. Certainly, it doesn't seem like there's yet a cap on these yields. We're just saying that they're getting to a point where they're pretty damn attractive. So for me, I think we're at a point where for the next few weeks before this quarterly refunding announcement comes out and we then know how well this information has been priced. And of course, it's possible that Treasury could really kick the can down the road and not issue as many bonds, but that's very unlikely and very dangerous and probably not what they're going to do. So you look at this and say, is it time to buy real yields? And the answer to that is for a trade for the next couple of weeks, can you buy the dips on both nominal bonds and real bonds and tips? Probably, but you don't want to you don't want to own them come Halloween.
Yes, and we will know more come Halloween. So I don't see any point in anticipating what they do. We just don't add to bonds
Right.
rather than anything else. And then we see what they announce on Halloween, and then we know how to react. But in the meantime, I think that there is a trading opportunity insofar as real yields being as attractive as they are is probably going to take the pressure that we've seen over the past couple of months off equities, and especially off the most sensitive part, which is the high duration equities. And we're talking about QQQ, we're talking about the Magnificent Seven. So I think there is potentially a significant trading opportunity if the real yields stabilize for the next 2-3 weeks to get a 2, 3, 4, 5% rally in something like the QQQs.
Yeah, I just want to. I forgot to answer the point. Make the point on nominal bonds. Nominal bonds and real bonds and tips are basically have been selling off at the same pace, and we don't see any reason why that should change because inflation expectations are not moving, and that's the difference between nominal and real bonds. And so, from a nominal standpoint, the same thing applies. They're probably okay in price, but they are facing this supply wall, which we're going to be cautious about. But Nick, I think the struggle I have with equities, and I think we should do something in equities in given the potential for the stabilization of real yields until we get to the QRA, with the possibility that earnings should be really strong, and we're about to go into earnings period. But I'm still pretty defensive on equities because, except for the Magnificent Seven, the 493 of the S&P 500 is substantially down for the year. So the question is, can we play the squeeze? And I think there's smart ways to do it. You mentioned a call spread, which I think is the right way to play it, which is you get upside, but you don't you sell what you bought if you're right. And I like that idea.
Yes. So to recap, what is our macro outlook here? I think we can agree that real yields are at a very attractive level, which historically has topped nominal yields. Whether that is broken because of the supply, the very significant potential of supply from the QRA announcement in November or not is yet to be seen. So what we are saying is the odds favor some kind of stabilization in the bond market over the course of the next 2 or 3 weeks. The bond market is going to start after the supply next week is going to look forward to the Fed and the QRA and is going to remain defensive in a range. If that happens, the pressure comes off something like the QQQs, which can probably rally 2, 3, 4, 5%. Then it's time to square up, sell them, and wait for the QRA and see what the implications of that are. And probably, if it's very strong and very bond heavy, as you might anticipate quite reasonably, then it's time to sell bonds again and go to minimum equities again and really ride the wave down, because I think the next wave down is going to be potentially much more impactful. Because it's one thing to go from under 2% real to 2.5% real, but to go from 2.5% real to 3 or 3.25% real and bust through a range that we've had for the past over 2 decades is going to be very impactful on equities. And I think the equity market would really take fright at that, because you're not going to have a 200, 300 point adjustment in the SPOOs. You're going to get a real downdraft. And I'm talking about 10% in a week. That kind of a move with volatility spiking into the 30s. That is what I would expect if reals start breaking out above 270, 275.
Yeah, I agree. You have to assume that at some point the real yield increase, the wealth effect decrease of people losing money on bonds is going to actually affect the real economy and cause a recession.
Yeah, and I keep on saying, if you can get 3% or 3.25% real yield, why would you invest in the stock market?
Yep. All right,
and
we agree.
Yeah.
Thank you for listening. This was a little long one. Nick will do his part, and we'll see you next week.
See you next week. I think it would be helpful to pictorially summarize what we've been saying in this episode. These are real yields, and as you can see, throughout the periods going back since TIPS have existed and we could calculate it very accurately, we've always topped around the 250, 260, 270 area, apart from this very brief period here during the recession of 2008, when real yields went very high, but this we can disregard because it was a technical reaction. So what we're saying is that we are likely to get a top around here. We reached 255 on Friday. And we feel that it's unlikely that we will go much higher in real yields over the course of the next few weeks, as well as nominal yields, because they are very much tied together. Given that, we think that there is a distinct possibility that the high duration stocks squeeze as a result. And we've chosen the QQQs, and we think that there is a reasonable possibility and indeed a probability that we squeeze from around the 363, 364 level on Monday all the way up to something like this, 377. And we think that that is a reasonable probability. How you structure the trade is entirely up to you, but with our limitations on the account, all we can do is a basic call spread, 364 to 377, out to October the 20th. Now, we think the strikes are the correct ones, i.e. at the money, with 377 being the top, and October the 20th is a reasonable time frame for that to happen, i.e. 2 weeks. That is when the trade should be at its most profitable, if we're correct. You could even do a 1x2, i.e. selling double the amount of calls at 377, because we think the likelihood of it going through 377 is extremely unlikely. We can't do that because of the self-imposed limitations we have on our account, but you could structure it like that. In fact, I would do that trade rather than this one. I have to do this one, but I would sell twice the amount there and limit the amount of premium that I'm paying. We will do that on Monday with a limit of 770, so we are basically buying it at 371-ish to sell it at 377. If you did twice as many, you would reduce that by about 15%. So that is the trade we're going to do. We're going to buy the 364s to 377 strike. We're going to do 2 lots, and that will make us risk about 2% of the account to try to make the same amount. Otherwise, I've updated all the amounts that we are long of. I am considering the TLT option that we have as in the money, and therefore that we are long about 6.4% in TLT. And I've actually reduced the cash we have here. We're not short of 17,000, but that's more or less what we would have to pay for it. And therefore we will see if that is exercised or not, because it doesn't expire yet. So when it does expire, if it were to expire here, these are the allocations we would have. So with the option that we're doing on QQQ, that would go up significantly, and we would reduce our cash to almost zero. But that is something that we're doing only for the next 2 weeks. It's not going to last longer than that, whether we make money on the QQQs or not. We are not going to keep them into the QRA, which comes out in November. Everything else is updated. The broker statements are uploaded here, so you can see exactly what we have, and even the monthly statement for September and the performance to date are all updated for you. If you have any difficulties downloading this Excel sheet like some people have had, please drop us a note and we'll try to solve the issue for you. Thank you very much indeed, and have a lovely weekend.